Tech sector higher today, moving back up towards its record highs, a gain of more than 1% for the Nasdaq. Our guest likes to look past the hype and directly at technical indicators. He says frothy sentiment can linger a while longer. We're joined by Ari Wald, head of technical analysis at Oppenheimer. Thanks very much indeed for coming on the show.
Thanks for having me on. Appreciate it.
Before we get into particular charts, in a market that some say is characterized by euphoria or FOMO, momentum investing, do you have to use technical tools a little differently?
I think they're generally used the same, but to your point, yeah, it's important to consider the environment that we're in and just using the mosaic, and you're not just going to look at sentiment alone, but what's happening in totality. And that I think there's some offsetting positives there, especially what we're seeing in our internal breadth work.
And you are, so tell us, investor complacency, is that a thing you're concerned about?
Yeah, well, that's the top concern, that what we're hearing from clients, just how much we've run, and that a lot of the investor polls have reached optimistic levels not seen in a number of years. That can be considered a contrarian concern. For instance, the investors' intelligence bull bear ratio now above the 4 reading, 4 times as many bulls as bears, most optimism since January of 2018, prompts the question, have market conditions become as good as they get? We don't think we're at that point. I think a couple positives. I think first, it's important to look at the driver of the strength. Why has markets become as complacent as they are? It's really been driven by technology, which has become one of the most overbought sectors. It's really driven the rally since last year's seasonal correction. But if you look at how technology behaves historically, it tends to be a trend following sector. In fact, it's a sector where you've seen the higher returns, the higher it is trading above its 200-day average. So if you're worried about being overbought in technology, history would suggest those concerns are overstated.
We have the next graph, which looks at small cap stocks. What pattern, or what do you expect will happen with small cap stocks, or what do you see as a likely scenario?
Sure. So in this case, we're taking the opposite approach. If one is worried about a market correction, historically speaking, selling small caps have been a really good correction hedge. So they've had more of a mean reverting tendency. If you look back historically, they are the area of the market where so good it's bad and so bad it's good has worked. Where they've had better returns below the 200-day and poorer returns above the 200-day. However, in this case, as a mean reverting area, you're still below the thresholds that have historically marked extension. And so instead, we see an area of the market that is just starting to break higher from an 18-month base, and we think can add firepower for the next leg of the equity cycle. And, this, if you look at the Russell 2000, this is why we haven't reached the as good as it gets moment, and why we think we're behaving in a more middle innings fashion.
But if the market itself tops out, small caps are extra vulnerable? We
think so, and especially they've been more of a beta trade in recent years. This is why we half jokingly say it's not about market valuations, when the cheapest stocks continue to lag on the downside when we get these volatility shocks. I think we're in a large cap led secular bull. I think that's consistent with history. We saw throughout the 80s and 90s large caps lead in relative terms, but we still need small caps to participate in absolute terms. And I think and that's what makes growth so attractive here. You have a large cap growth component. That's your core position of your portfolio. And I think you can now rotate down capitalizations and look at mid cap and small cap growth that we think offers some attractive rotation potential.
Let's get to your final chart here. This picture makes a case that the tech sector can keep rallying. Walk us through it. It depicts the S&P Technology XLK.
Right, sure. So this is getting back to the point that this has been a trend-following sector, where if you look at better returns when it's above the 200-day average and when it's below it. And I think just simplistically looking, what you want to look at is that we're only 4 months into this 2-year breakout in trend. It's a sector that's just getting above levels from its peak levels from 2021. So in our estimation, this steadily paced secular bull market continue. I think that's an underappreciated fact. If you look at the long-term rate of change levels of the NASDAQ or this tech sector, far from the extreme seen in the late 1990s, we'd argue that the steadiness is underappreciated, that there's been checkbacks along the way. And for these reasons, I think that long-term uptrend is continuing with that breakout above peak levels from a couple of years ago.
Ari, before we let you go, so it sounds like with qualifications, and of course there always are, signs of investor over-exuberance, but you think this market could broadly, on the technical indicators, push higher for a while?
We do. I think the key point is that we are still below average in terms of both magnitude and duration, looking at this cycle and cycles past. We came into the year saying the S&P 500 was conservatively undervalued below 5,400. Typically, bottom to top, median bull market cycle, 70%. If you only look at the 10 shortest bull markets ever, that median drops to 60%. 5,400, that would only be a 50% rise. That's why we think we're conservatively undervalued below there. 70% of these bull market cycles make it to their 2-year anniversary. You add it up, and we think it is very reasonable that we continue to rally through year end.